another nugget that he talks about in the book Intelligent Investor is to run your own race. You see, every investor is unique. And so when I get asked all the time, what asset should I buy? What investment should I make? Is this a good investment for me? A lot of times I have to respond with, it depends. And people don't like that answer, but it does depend. It depends on lots of things. And back to what Benjamin Graham says is you have to run your own race. What's best for me today may not be best for me next year. And what's best for me today may not be and probably isn't best for you either. And so we have to figure out what our own race is, what makes us unique, and we have to make investment plans that suit our own investment goals, our time horizon, and more importantly, where we're at. You see, we're all going to a different place and starting from a different place. Like, sure, yes, we'd all want to be financially free. I suppose we're all going for that. But what does that even mean to you? Is that $5 million in the bank? Is that $5,000 of passive income coming in per month? Like, what does that even mean to you? And then where are you starting from? Do you have 50 million in the bank today? Do you have no money? Do you have a job? Do you have any income? Right? And so we're all starting from a different place. And we all have different time horizons. Like, I don't really plan on retiring. I'm hoping that I'll work till I die because I enjoy what I do. Where some of you are like, I need to retire in the next 3 years because I hate this. So we have different time horizons. But more importantly, it's because we're all unique. So something Warren Buffett got from this is something known as the deal box. Warren Buffett only invests into things that he understands that are in his deal box. Think about if you're watching a baseball game. It's and you have someone at bat, and they show like on the screen sort of the strike zone. So he has his strike zone, he has his deal box, and he only goes into deals that he understands that fit in that criteria, as do I. I invest into things that I know and I understand. If I don't know and understand them, then there's too much risk for me. All right. It'd be like you live in the Midwest somewhere, and I take you to Hawaii where the waves are 30 feet, and I take you out to go surfing. You don't know anything about the ocean. You don't know anything about waves, much less those big of waves. It's extremely risky, and you could probably die. I've been surfing over there a lot. I'll probably be okay, but it's because I have expertise in that area. Now, you're from the Midwest. You might take me to a rodeo and try and put me onto a bull. I know nothing about that, so it's probably way too risky for me to do that, but you might be okay with it. And so we need to understand where our competency is, where our area of expertise is, and we should stay within that. Now, you can become an expert in another area if you want to, but what you have to understand, as he says in the book, is that he says that investing isn't about beating others at their game. It's about controlling yourself at your own game. So figure out what your own game is. What game do you want to play? What game can you become an expert in? What are the rules that you'll play that game by? Set those parameters and stay inside those parameters. Do what makes you unique, because what's best for me isn't going to be best for you. Another one of the adages that we get out of the book, and this is one that Warren Buffett certainly took to heart. He's famous for saying it, but he talks about Benjamin Graham in The Intelligent Investor says that to be an intelligent investor, you must focus on risk management. The best investors in the world focus on risk management first, and they focus on returns second. Warren Buffett says that the single most important rule with investing is to not lose money. The second most important rule in investing is don't forget number one, which is don't lose money. And what I see from the thousands of comments I get across my social media and all the new investors I get into my financial newsletter I've been writing for the last 7 years is they all want to know how much they can make. How much can I make from this one? What position can I buy that will make my money go up the fastest? They're all trying to think about how much they can make instead of protecting their downside. And that's the big mistake. You must always focus on risk management. As Benjamin Graham says, the best investors focus on risk management first and returns second. You have to understand that losses are asymmetric. So what does that mean? If I lose 50% on a certain investment, I have to make back more than 100% in order to get back the 50% I lost. So you probably are aware, making 100% is very difficult. We're seeing the average annual returns of the S&P 500, depending on what time frame you want to look at it, are somewhere in the 7 to 9% range. That's what they return. Ray Dalio, one of the most famous investors in the world, the founder of Bridgewater Capital, the largest hedge fund in the world, I think, has averaged about 11% return in his career. So to make 100% is very difficult, but to lose 50 is pretty easy. And so we don't want to chase that. We need to have proper risk management. Another one that we saw in the book that really caught my eye, and this is the big one, coming up into holiday season, is that corrections offer opportunities. You want to be buying assets when everyone else is selling them. And going into Black Friday, I think this is interesting because you'll see all over the news people standing in line all night long in order to get in first to a Walmart to get a new TV. They're going to stand outside all night to save a couple $100 on a TV. This is the mentality when things go on sale. But when assets go on sale, financial assets go on sale, stocks, houses, etc., people don't want to touch them. When Bitcoin is at new all-time highs, people I haven't talked to in years are coming out of the woodwork and asking me if it's time to buy when it's at the high. But when Bitcoin makes a low, everybody wants to sell. Everybody wants to run away. Everybody's scared. This is counterintuitive, and it's because of our human emotions. So we want to buy when everyone is selling, and we want to sell when everyone is buying. In the book, he says the intelligent investor is a realist who sells to optimists and buys from pessimists. So which one are you? Are you an optimist? The glass is half full. Are you a pessimist? The glass is half empty. Or are you a realist and you just drink the water? And that's what we want to be. We want to be realists. We don't want to be overly optimistic or pessimistic. We want to understand the value. Remember, price is what you pay. Value is what you receive. We need to understand the value of what we're buying. We need to understand where the market cycles are. And we want to buy when there's blood in the street, as Mayor Rothschild said. We want to buy when everyone's selling, when things are cheap, when things go on sale. You don't need to wait in line all night at a Walmart, freezing cold, standing up to save $100. You could just go buy a financial asset on sale and make a lot more.